You know, I've learned through a lifetime of watching the tape that markets don't reward the man who tries to do everything at once. They reward the man who knows how to make small, deliberate changes, and then lets time and discipline do the heavy lifting. That's what we're talking about today: small tweaks, big results. Now, if you caught the previous video on how to read market structure for Breakout, you'll remember I said something about watching the line of least resistance, the way a stock tips its hand before a real move. Today's talk is the natural extension of that idea, because once you learn to read the tape and spot the turns, it's the little refinements in your execution that turn a decent trader into a real operator. Let me tell you something I've seen countless times: traders spend years hunting for the perfect system, the magic formula, the one signal that will never fail. They'll rewrite their rules every month, change indicators like shirts, but they overlook the power of small, consistent improvements. A tweak in position size, a slight delay in pulling the trigger, a half step more patience before exiting. These are the things that compound into real skill. Tell me, have you ever noticed how the smallest mistake, getting in a bit too early or out a bit too late, can make all the difference in a campaign? Most folks think in extremes. They see a stock jump and they rush in with both hands. Or they get shaken out because of one red bar. But trading doesn't reward the impulsive. It rewards the watchful, the man who studies himself as carefully as he studies his charts. Every adjustment in your method, every bit of self-control you build, is like tightening a screw on a fine instrument. You don't need to rebuild the machine, just keep tuning it. When I was young, I used to think the big money came from the big trades. But that wasn't true. The big money came from getting the small things right. I made fortunes by waiting, not by acting. By holding my position when the trend was still sound, even when the market tried to shake me out. A small tweak in my patience paid more than a dozen lucky trades ever could. Think about it. Have you ever cut a winner too soon, just because you wanted to lock in profits? That's one of the deadliest habits in this business. A trader tweaks that impulse, learns to wait for confirmation instead of emotion, and suddenly his whole game changes. He doesn't just make more, he keeps more. You see, the public always wants excitement. They think trading is about doing something every day. But real trading is about doing the right thing when the setup is right. And you only learn that by making small adjustments. In your timing, in your judgment, in your temperament. Now, the reason this connects so closely with that previous lesson on reading market structure is simple. Once you know how a market builds a move, how it accumulates, tests, and breaks, the next step is learning how to adjust your own behavior around it. It's not just reading the structure, it's reacting with precision. A small shift in your risk control, a better understanding of where the breakout truly begins. That's where the power of small tweaks reveals itself. When I studied the tape, I didn't try to predict the future. I tried to align with what the market was showing me. I'd watch how volume flowed, how prices reacted to support, and I'd adjust my approach bit by bit. Never in leaps. The big results always came from small refinements, from correcting one weak habit at a time. Let's say you find yourself jumping into trades the moment a breakout candle appears. 9 times out of 10, you'll get trapped in a false move. Now imagine you tweak your rule. You wait for the retest, for confirmation that the line of least resistance has really changed, that one small tweak could be the difference between a loss and a campaign that runs for weeks. Do you see how subtle the game really is? The best traders I've ever known weren't men of wild courage. They were men of quiet precision. They knew when to do nothing. They knew how to wait. That's not a grand revelation, it's a practice discipline. And that kind of discipline comes from small, deliberate tweaks. You can't change your temperament overnight. But you can adjust how you respond to fear and greed, one trade at a time. There's a saying I've always kept close. A speculator must learn to sit tight. But sitting tight doesn't mean sitting idle. It means refining your edge while you wait. Watching the market teach you. Adjusting your notes. Finding that one pattern you misread last week and understanding why. That's how you build skill in this game, not by adding noise, but by shaving it away. And remember, every tweak must be grounded in observation. You don't just change for the sake of change. You study the market, you study yourself, and you adapt only when the facts justify it. That's what separates a method from a gamble. The public jumps from one idea to the next. The professional tests one idea until it becomes second nature. Let me ask you, how many times have you thought, if I'd just waited another day, that trade would have worked? Or, if I'd just risked half as much, I'd still be in the game. Those aren't just regrets, they're clues. Each mistake is a map pointing you toward your next small adjustment. Trading isn't about finding perfection. It's about refining imperfection. The man who learns to make one better decision today than he did yesterday, that's the man who survives the cycles, who builds real wealth over time. The markets will always change, but human nature doesn't. You can't control the crowd, but you can control your responses. That's the real edge. Small tweaks in your patience, small tweaks in your risk, small tweaks in your observation. Over months and years, these tweaks compound into mastery. You won't notice it day by day, but one morning you'll look back and realize you're not the same trader anymore. The noise doesn't move you. The fear doesn't sway you. Because you've tuned your craft. And just like I said in that earlier discussion on structure, when you understand how the market lays its groundwork before a breakout, you begin to see how you, too, must lay your groundwork before a big move. The process is identical, slow, steady accumulation of skill until momentum builds on its own. So don't chase transformation. Chase refinement. Because in this business, the man who learns to make small tweaks, precise, disciplined, intelligent tweaks, is the one who ends up with the big results everyone else only dreams about. Small adjustments in execution compound into major trading improvements. It sounds simple, but it's one of the most overlooked truths in speculation. Most traders, especially when they're new, chase the big leap, the grand discovery that will suddenly make everything work. They believe there's a missing secret hidden somewhere, a system they haven't found yet, an indicator that can predict the next wave before it happens. But the truth, the one that only time in the market can teach, is that improvement rarely comes in leaps. It comes in inches. In trading, the smallest adjustments to your execution, the timing of your entry, the precision of your exit, the patience between, compound quietly into massive differences in results. When I was cutting my teeth in the bucket shops, I thought the game was about calling tops and bottoms. I wanted to be right, not consistent. But every time I forced a trade, every time I jumped before the market confirmed my reading, I learned the same expensive lesson: precision is built, not discovered. You can have the right idea, but if your execution is off by just a fraction, you lose. The market doesn't pay for good ideas, it pays for good timing. That's what makes small adjustments so powerful. They tune the only part of the game you can truly control yourself. Let me put it this way. Imagine two traders reading the same chart, seeing the same breakout forming. One enters on impulse, the moment the price pokes above resistance. The other waits for confirmation, lets the market show its hand, and enters only when volume confirms the move. On paper, the difference looks small. In practice, it's the difference between catching a false breakout and riding a genuine trend. That's the scale of what small executional tweaks can do. Ask yourself, how many trades have gone wrong not because your analysis was poor, but because your timing was premature or your conviction was weak? That's where execution lies, in those subtle decisions between analysis and action. Small tweaks like adjusting the time frame you watch, the entry confirmation you require, or the stop placement you choose, can transform a series of losses into a consistent record of controlled outcomes. A trader's growth often begins the moment he stops trying to trade everything and starts trying to trade better. You refine your setups, cut the noise, and find the rhythm that fits your temperament. That's not glamorous work, but it's the work that separates amateurs from operators. Most traders overcomplicate their charts with tools, thinking more inputs equal better decisions. In reality, less clutter means sharper execution. Small tweaks toward simplicity often bring the biggest clarity. And let's talk about exits, one of the hardest parts of the craft. Everyone wants the perfect entry, but it's the small improvements in how you take profits and manage stops that make the real difference. Maybe you stop trailing too tightly. Maybe you start scaling out instead of selling all at once. Those aren't radical changes, they're refinements. But over time, they change your entire equity curve. You preserve more capital, you reduce stress, and you gain the one thing most traders lack: consistency. The key is repetition. A single tweak won't save you, but applying one small improvement across hundreds of trades builds skill the way compound interest builds wealth. Every slight adjustment in how you execute adds up, creating smoother performance, steadier confidence, and sharper instincts. Trading is cumulative that way. Each trade is feedback. Each mistake is instruction. The difference is whether you notice it and adapt. Remember, the market doesn't owe you anything. It simply reflects your preparation and discipline. If you want better results, start by looking at your smallest habits. Do you rush your entries after seeing a big move? Do you move your stop to break even too early, just to feel safe? Do you hesitate when the setup aligns perfectly because of your last loss? Each of those behaviors represents a place where a tiny tweak could change your entire outcome. You don't need to overhaul your method. You need to refine your execution. When you look at the great operators of any era, you'll find they rarely reinvented their systems, they just perfected them. They learned to execute cleanly, without hesitation or excess. They repeated what worked and trimmed what didn't. Over years, those refinements compounded into what looked like instinct, but it wasn't instinct. It was trained precision. Every small adjustment they made became part of their natural rhythm. Now, it's easy to underestimate the power of small changes because their effects aren't instant. You don't see the result after one trade or 1 week. But give it months, give it 100 trades, and those small improvements turn into an entirely new level of performance. The way you handle entries, manage risk, size your positions, or control emotions. All of that evolves through gradual, conscious refinement. If you go back to what we discussed in that earlier lesson on reading market structure for breakout, you'll notice the same principle there too. You don't identify a breakout by guessing. You read the build-up, the accumulation, the tightening, the pressure forming before the release. In other words, the big move starts from small, consistent patterns. Your execution follows the same law. Major improvement begins with small, repeated calibrations. When a trader becomes aware of how these tweaks compound, he starts paying attention to details most people ignore. He times his entries with more care, not haste. He checks volume flow before pressing the button. He refines his stop, loss placement from emotional safety to logical structure. These are quiet changes. No one sees them, but they transform his entire relationship with the market. It's the same in life, really. You don't become a disciplined trader by reading one book or taking one big leap of confidence. You build it through a series of subtle, conscious corrections. Day after day, a little less fear here, a little more patience there. Execution sharpens, emotions stabilize, results improve. And that's the true secret behind compounding and trading. It's not just compounding money, it's compounding discipline. Every small, deliberate improvement in execution multiplies over time, shaping you into a trader who doesn't need luck to survive. Precision matters more than prediction in market operations. That's a truth most traders never really grasp until the market teaches it to them the hard way. Everyone wants to be the one who calls the next big turn, the man who says the top is in or the bottom is set. But markets don't pay for opinions, they pay for execution. The fellow who can act precisely, who can line up his trades with the rhythm of the tape, will beat the one who tries to forecast the future every single time. You see, prediction feeds the ego, but precision feeds the account. The crowd loves to predict because it feels powerful. They want to sound smart, to be right before everyone else. But being early in this business often means being wrong. You can predict correctly and still lose money if your timing is off by a few points. The market doesn't reward the thinker. It rewards the operator. the man who waits for the signal and acts with control when it appears. Have you ever found yourself predicting a move perfectly, only to see your position get stopped out before the market finally went your way? That's what happens when prediction runs ahead of precision. The tape doesn't lie. It doesn't care what you think, what you feel, or what you expect. It only reveals information to those willing to watch and wait for clarity. When I traded in the old days, I learned this lesson on the exchange floor, watching the prices shift like a living thing. I'd make my plan in the morning, but by midday the market would often show me something new. A reaction, a hesitation, a test of strength. The inexperienced trader would cling to his prediction, insisting the market had to move his way. I learned to drop the prediction and follow the evidence. Precision meant aligning myself with what was happening, not what I wanted to happen. That's why chart reading is an art of patience and exactness, not prophecy. You don't guess the move, you identify the moment when the probabilities are most in your favor. You measure, wait, and strike only when the odds align. A good trader doesn't need to know what happens tomorrow. He only needs to know when the market is tipping its hand today. And when he acts with discipline. His entries are clean, his stops logical, his position size deliberate. That's precision. Prediction tempts you to be emotional. It makes you stubborn. When the market doesn't behave as expected, you start arguing with it. You hold losers longer because you think your prediction will still come true. Precision, on the other hand, forces you to be mechanical. It's rooted in structure, in process, in response rather than anticipation. You take the signal, you respect the stop, you follow your method, and by doing that, you trade what you see, not what you hope for. Tell me, how many times have you lost money because you were sure the market had to move a certain way? Now, in that earlier discussion on how to read market structure for Breakout, we talked about how markets build their moves through accumulation and preparation before a genuine breakout occurs. That's a form of precision too. You don't predict the breakout, you watch the structure tighten, you observe volume contraction, and you act only when confirmation appears. That's the practical difference between guessing and operating. The one who predicts acts on assumption, the one who trades with precision acts on evidence. Precision also means understanding your own tools. Many traders think the answer lies in adding more indicators or changing strategies every month. But precision isn't about having more data, it's about having cleaner data. Fewer distractions, sharper signals. You don't need 20 charts to tell you what one clean setup can show. Simplify your process until you can read it with confidence, and you'll find precision grows naturally from repetition. The best operators in any market share one trait: they never rush. They can wait for their setup the way a sniper waits for his mark. They aren't anxious to be in a trade, they're patient to be in the right trade. And when it comes, they execute without hesitation, because they've seen it 100 times before. Their edge isn't prediction, it's timing, accuracy, and emotional control. Think of it this way: prediction is like throwing darts blindfolded and hoping one lands on the bullseye. Precision is like removing the blindfold, taking careful aim, and throwing only when you're ready. You may not hit the exact center every time, but you'll be consistent. And consistency is what compounds over a career. Another thing about precision: it's closely tied to self-awareness. You can't trade precisely if you don't understand your own tendencies. Are you prone to overtrading? Do you move your stops too early? Do you add to losing positions because you think the market will turn in your favor? These are the behaviors that destroy precision. You must study them, just as you study your charts. Every small flaw in execution can be corrected if you're honest enough to see it. The beauty of precision is that it's measurable. You can track it, refine it, and improve it. You can measure your entry accuracy, your average drawdown, your reward to risk ratio, and you can make small adjustments that yield enormous improvement over time. That's how a trader evolves from random results to structured performance. The market doesn't need your opinions. It doesn't need your forecasts. It needs your respect. When you start trading with precision, You stop fighting the market and start cooperating with it. You let it lead, and you follow its signals faithfully. It's not about being right, it's about being in sync. That's what makes precision such a rare quality. It demands humility. You must admit you don't know what the market will do, but you're prepared to act correctly when it does it. Most traders can't handle that kind of uncertainty. They crave certainty, so they predict. But the seasoned operator embraces the uncertainty and focuses on control instead. Precision is what separates a professional from a hopeful amateur. The professional knows that every tick, every bar, every signal carries weight. He acts when conditions align and steps aside when they don't. He doesn't need to know the future. He only needs to recognize the present clearly enough to act decisively. And that clarity, that discipline is what builds profits over time. Every trade, every execution, every controlled decision adds to that precision. You don't build it overnight. You build it through observation, through correction, through patience. When you stop trying to be the fortune teller and start becoming the craftsman, the operator who executes with accuracy and control, you finally begin to trade like a professional rather than a participant. And that's when you start to see how precision, not prediction, truly drives success in this game. Emotional control outperforms any technical indicator. That's not a poetic idea. It's a trading truth carved in experience and losses. You can have the finest charting system, the cleanest analysis, and still watch your account drain away if your emotions are running the show. The market doesn't defeat traders because of poor tools. It defeats them because of poor temperament. The best setups mean nothing if fear makes you exit too early or greed makes you stay too long. Every tick on the tape is a test, not of your strategy, but of your emotional control. I've seen traders ruin themselves not because they didn't understand the market, but because they didn't understand themselves. They let excitement replace logic, or panic override patience. The market can smell emotion the way a shark smells blood. It feeds on the man who trades to feel something instead of to do something. Tell me, how many times have you broken your rules because a trade felt right, or felt wrong, in the moment? That's the lack of control that quietly erases good work. A trader's emotions are his first and last battlefield. The tape moves in cycles: hope, fear, greed, despair. And most traders follow those emotions like a shadow. The winners, though, learn to step outside that rhythm. They feel the same emotions, but they don't obey them. They trade their plan, not their pulse. That's emotional control, the ability to act by decision rather than reaction. You can't measure that on a chart, but you can see its effects in your results. Emotional control is what keeps you from chasing every green candle or cutting a position the moment it breathes against you. It's what allows you to hold through the noise, trusting your setup and respecting your stop. It's what gives you the power to say, I don't need to trade right now, when the market's unclear. In short, it's the difference between discipline and destruction. When I was young in the game, I used to think success came from better predictions. I thought if I studied hard enough, if I read every price pattern and memorized every reaction, I'd finally find certainty. But the market never gives certainty. What I found instead was that the men who lasted, the real professionals, didn't trade with more knowledge, they traded with more calm. They could see a loss without anger, a win without excitement. They stayed even while everyone else was swinging between extremes. If you've ever felt your hands tighten on the mouse, your breath quicken, your eyes locked on the screen, you know that tension. That's the moment where trading becomes emotional, not mechanical. Emotional control means recognizing that sensation and not letting it dictate your action. You might feel it, but you don't let it command you. That's mastery. Think about this. When a stock starts breaking out, what's the public's first reaction? Excitement. They rush in, afraid to miss the move. When it dips a little, that excitement flips to fear, and they sell just before the real breakout begins. The tape hasn't changed, only their emotions have. The professional does the opposite. He remains calm, reads the structure, and waits for confirmation. That control, not the indicator, is what earns him his profit. And this is where our previous lesson on reading market structure for breakout ties in naturally. You can identify the build-up, the compression, the breakout zone, but without emotional control, you'll misread it every time. The moment the price hesitates or fakes out, you'll doubt your own analysis. You'll either jump too early or freeze too late. That's why control matters more than the setup itself. Because your emotions distort what you see, and you can't trade clearly if you can't see clearly. Now, emotional control doesn't mean suppressing feelings. It means understanding them. You can't remove fear or greed from trading. They're part of human nature. What you can do is create rules that protect you from acting on them. That's what stops, position sizing, and trade plans are really for. They're not just risk tools, they're emotional buffers. They turn impulsive reactions into structured behavior. A trader with control accepts uncertainty. He knows not every trade will win, and that acceptance keeps him balanced. But the emotional trader expects certainty. He believes the market owes him clarity, and when it doesn't give it, he gets frustrated, angry, reckless. He adds to losing trades, cuts winners too soon, and tries to fight the market into agreement. The market always wins that fight. Sometimes the most powerful action a trader can take is to step away, to not trade at all. The undisciplined trader can't do that. He feels the need to be in the market constantly, to prove something to himself. The trader with control knows that patience is a position too. Waiting isn't weakness, it's wisdom. Have you ever noticed how many of your worst trades came from boredom, not opportunity? That's emotion, not logic, driving the wheel. The greatest traders I've known had one thing in common: they were calm in chaos. The market could be swinging wildly, and they'd sit there, quiet, watching, calculating. Their heart rate didn't change. That calm wasn't natural, it was trained. It came from experience, from learning that reacting emotionally only fed the market's traps. They learned to let the market move first, and their mind follow second. Indicators can't give you that kind of strength. They can tell you when volume expands, or when moving averages cross, but they can't tell you when your fear is about to sabotage your judgment. That's the work you have to do yourself. Every trader has to build his own system of emotional management. Whether it's journaling, meditation, stepping away from screens, or enforcing strict trading hours, you control the tool before the tool controls you. In the long run, the traders who succeed aren't the ones who know the most patterns. They're the ones who can keep their head straight when others are losing theirs. They can sit through drawdowns without panic. They can watch missed opportunities without chasing, and they can close a loss without frustration. That's emotional control in motion. Quiet, steady, unfazed. Every time you choose discipline over impulse, you strengthen that control. Every time you stop yourself from forcing a trade, you build it a little more. It doesn't grow in a single day. It's built trade by trade, moment by moment. The more you practice it, the more natural it becomes. Eventually, emotion stops being your enemy and becomes just another signal, something to observe, not obey. And when you reach that point, you begin to trade from clarity rather than chaos. The line of least resistance rewards disciplined alignment, not constant action. Most traders misunderstand this simple truth. They believe success in the market comes from doing more. More trades, more analysis, more screen time. But in reality, it comes from doing less and doing it right. The market doesn't pay you for activity, it pays you for accuracy. Finding and following the line of least resistance means aligning yourself with what the market is already showing, not what you wish it would show. It's the art of moving with the current instead of fighting it. When I first began studying the tape, I was obsessed with catching every turn. I wanted to call the exact top, to buy the very bottom. But after years of trading and losing, I realized the market doesn't reward the man who tries to be clever. It rewards the man who learns to follow the path of least resistance, the direction where price naturally wants to go. That's where the real money is made, quietly and patiently, by those who have the discipline to wait for the market to show its hand. You can see the line of least resistance in any trend. When the market rises, it does so in waves. and each pullback tells you something about the strength of the move. The inexperienced trader fights those waves, trying to pick the reversal. The disciplined trader aligns himself with the momentum and rides it. He doesn't predict. He responds. Tell me, have you ever watched a trend unfold and thought, it can't go higher, only to see it double again? That's the penalty for ignoring the line of least resistance. The crowd hates waiting. They want to act. They think constant movement equals progress. But the best operators understand that waiting is part of trading. You wait for the market to set its direction. You wait for your price to come to you. You wait for the odds to align. The market rewards that kind of patience because it's rooted in discipline, not emotion. When you act only when the line of least resistance is clear, your risk shrinks and your profits stretch. Following the line of least resistance means studying structure, not just movement. You don't look at one candle or one swing. You read the whole story. You watch how price reacts to key levels, how it behaves when tested, how volume confirms or denies strength. That's how you see where the path is smooth and where it's blocked.